Good morning. I'm very excited to be here. I am very passionate about the military and veterans, and I am going to make you a little more entertaining at a cocktail party because you're going to be able to speak banking and SBA a little bit better after this presentation. So they gave me a lot to cover, so I'm going to cover it, but I'll try to make it entertaining. In the military, everything's about subject matter experts. And in this space, especially in the SBA space, I run one of the largest SBA platforms in the United States, and we do probably have 40% of our dollars are on franchises. So this is very important to us. And then teaming with Steve and IFA, we've launched a veteran franchise initiative. So that's why I think I'm not by accident why I'm standing in front of you today. But also, more importantly, I'm a 5-year active duty Air Force veteran. I flew airplanes and bought satellites, kind of a weird combination, but you all should be much more comfortable that I'm no longer flying. And then I spent 16 years as a naval intelligence officer, and I know naval intelligence is an oxymoron, but I actually think we did a pretty good job. So I'm really going to talk about the SBA program because for most new franchisees and someone looking to do 1 to 5 stores, this is the traditional method to do it. It's usually the SBA program. So this is the U.S. Small Business Administration program. It was started in 1953 during the Eisenhower administration. Speaking of the military, that's a name you should recognize. And I will tell you, whether you're Republican, Democratic, or Independent, this is one government agency that absolutely works. I've been doing this a long time, and it's great to see small businesses grow, and this really doesn't make a difference. And the main program of the SBA, the 7A program, is now zero subsidy, which means there's no tax dollars paying for it. The program pays for itself. So that's a neat thing. And I'll also tell you, forgetting who you voted for, in a positive structure, the President of the United States has a great deal of influence on this program. The head of the SBA, Karen Mills, reports is on his cabinet. So it has a lot of direction, and the Obama administration is very pro-SBA and has been very active in the program. 2 years ago, they increased the maximum SBA size from 2 million to 5 million. Folks, that is a big change. That is a giant change. So the purpose of the program is to aid, counsel, and assist. And it's important to tell you that the SBA program, other than natural disasters like Sandy, doesn't do any direct lending. So it's all done through banks and financial institutions. That's why we kind of combine these two subjects together, and we'll make you smarter on it. All right, what are the advantages to the customer? That's what you all care about. So there's 2 big advantages. One is the loan terms. The loan terms are much longer than traditional. So on CREs, commercial real estate, so remember this is all business lending, and it's owner-occupied real estate. So an owner-occupied is generally 51% or more, just to kind of put a flavor in it for you all. Go out fully 25 years, and that's just like a home mortgage. It's 25 years fully amortizing. If you're not familiar with commercial banking, most commercial banking, they'll go out 20 to 25 years, but they're going to have a 5 or 10-year balloon payment. So it's not going to be fully amortizing. There'll actually be a time where there's a maturity and there'll be an outstanding balance. Advantage, again, of the SBA, it's fully amortizing. Production equipment. Now I'm gonna preface this by saying production equipment. How many people have seen like big CNC machines that stamp out car doors and that kind of stuff? You can do those up to 15 years on the SBA program. It is not going to be traditional restaurant, kitchen type equipment. That you can do up to 10 years, but so it's up to 15 years with a useful life. You're going to see most of the equipment financing being at 10 years. And that's a very traditional term in the franchise space because most of our franchises have leasehold. They're not a lot, probably 25-30% have commercial real estate. Most are you're leasing the facility. So most of our terms are at the 10-year point, which also flows into working capital. Now the lower down payment, that is specific to commercial real estate and equipment. So if you went for a commercial loan, and it was non-SBA, you'd be looking at 20 to 30% down if you're on a real estate loan. Does that make sense to you all? So, and today in the residential world, it's coming back a little bit. We're starting to see the pendulum swing again. Everyone's going to forget about 2007. But traditionally right now, it's 20% down on residential and 20 to 30% down on commercial. Again, using the SBA, you can put 10% down. That's a big advantage to you all. If on a acquisition or purchase, meaning a new store on franchises, most of the lenders are going to be anywhere from 15 to 30% down, depending on how strong they view that concept and how strong you are. Probably think about 20 to 25% just as a general, if total cost is what you're going to have to bring in. Make sense? Okay. Really nice thing about the SBA program is generally there are no loan covenants. Does anyone know what a loan covenant is on a commercial loan? So they can be generally not a good thing, so we'll start there. But what it will do is it will say you have to have a certain debt service coverage. You have to have certain ratios. Your current ratio, and I don't want to bore you with the math, but there'll be certain ratios and stuff that you have to meet in a commercial loan. That is very traditional in a commercial loan. In an SBA loan, it's very traditional not to put it in there. The only real covenant that you have to do is you have to make your payments. That's really the key. If you make your payments, you're all good. If you don't make your payments, you're not all good. Any questions on that? And so I do argue that within the banks. I said I work in a very large institution or a very big shop. We argue this from time to time. And I said, look, let's make it very clear. The covenant is they pay us back, and you get the 75% guarantee from Uncle Sam. We'll cover what that means in a minute. If you don't remember anything about my presentation, remember that term preferred lender. There are approximately last year 3,100 financial institutions that made an SBA loan. That's pretty big. Of that, probably 85% made 5 or less. How many of you all play golf? How's your golf game if you play it once a year? You starting to get where I'm going on this? So as a preferred lender, and a lot of banks have this, so this is not a commercial. This is a question to ask. If you're looking at an SBA solution in a bank, a credit union, ask the question, are you a preferred lender? And what that means is you have qualified and earned the designation from the SBA, and you make the credit decision for the SBA. So this loan doesn't go to the SBA for loan approval. We do have to submit some financial information. Mainly, believe it or not, one of the big questions is, were you a veteran? That's one of the things we have to see. So we actually send the SBA electronically the name of the business, the personal information of the owner. One of the big questions, are you a veteran? Are you a minority? What college you go to? And there's one other thing. Were you a felon? That's a big one. And that's pretty much what they see, and it takes about 27 seconds, and I get an email back with the loan number because they're not seeing any underwriting. They're not seeing any financials from you. They're not seeing your FICO score. They're not seeing your debt service. All they're seeing is the name of the company, and they collect a lot of stuff in terms of military, minority, woman-owned, and so that's something they go through. But the preferred lender status does two things. One, it's going to speed you up about a month if everything goes right. And I say if everything goes right, but remember if you play golf once a year, when you play that once a year, does everything go right on the golf course? No. So I would really, lots and lots of banks have that designation. I would just, if you remember nothing else, remember this one, because if you don't, then you're going to remember it when you're calling them. They don't know what they're doing in their 18th week of underwriting it. So the good and bad news, it's a great program, but you got to know how to do it. Make sense? All right, there's two main programs, and this will make you really, really key at the cocktail party. If you know this stuff, you're going to just be wowing them. They're going to love it. I'm just joking. They're not going to care. But the 7A program is the main program, and so the SBA is very much like the military. Lots and lots of acronyms. So you'll at least get that part right. So let's get some general parameters of the program. It's very simple. The program's used for businesses for all general commercial purposes. So if it's for the business and it's a commercial purpose and it benefits the small business, it's pretty much eligible. What you can't do is you can't take the money personally out from the SBA and buy a yacht unless you're doing some sort of, we just made a loan to a yacht club on some ship that they rent out. But in terms of the personal yacht, it's not to buy you a Ferrari. It's for the benefit of the small business. That kind of, if you keep that in mind, it's pretty simple. The maximum loan amount is $5 million on the guaranteed program. And then again, we've covered the terms, 25 years on the real estate, 15 years on the equipment, 7 to 10 on working capital. Again, most of what we see on the franchise side is the 10 years. Only time you're going to see probably shorter, well, you see longer if there's commercial real estate involved, and then you would see, and it'd be a blended rate between the real estate and the non-real estate, so maybe it would end up being like a 17 or 20-year term, depending on how that ratio looked. The only time you'll usually see less than 10 years is if you're super, super strong. If you're really, really financially strong, we might move that down to 7 years, and the SBA likes us to do that. The maximum is the nice part about the SBA, there are maximum interest rates. So right now, the maximum interest rate is prime plus 2 3/4. Prime is 3 1/4. So that makes your maximum interest rate 6%. You think 6% is real high? That's pretty good. And you're going to see most of the SBA loans done between 5 and 6%. And then you're going to see them done in a variety of ways, whether it's variable or fixed. I will say the majority are going to be variable quarterly. That's what you're going to see mostly. But if you look around and you're real strong, I would say, try to look in, especially in this low-rate economy that we're in right now. If you can get anything that looks fixed, maybe it's a 3-year fix, maybe it's a 5-year fixed. I'm not your CPA, I'm not your economist, but I would like to lock in at these lower rates right now. I mean, certainly I don't think rates are going to go down. So that's something important. There's also an express product that's important because a lot of big banks deal with the smaller loans programmatically, meaning they have a machine that kind of does the underwriting and so forth, and you can use the bank can use its own documents. So the bank gets a lower guarantee on that. The maximum loan size is $350,000. The great news for veterans is there's a Patriot Express program, and that goes up to $500,000. So that's just important to note that there is a specific program in SBA for veterans that pushes this ability for the bank. It's easier for the bank. If it's easier for the bank, it's easier for you to get approved. Does that make sense? The bank likes it more. If the bank likes it more, you should like it more because the better chance of getting approved. And again, it goes up to $500,000 specifically for veterans. How can these proceeds be used? Just so anything commercial. So buying land, doing construction. Also put clear on here if you have existing debt that you think is not on reasonable terms, SBA is eligible to refinance. It's everything about this is creating cash flow for the borrower, enhancing their cash flow, letting you all concentrate on margins and market share, and hope providing some relief on your cash flow. We can expand and renovate. You don't see a lot of receivable financing. That's up there, it's allowed, but you don't see that quite as much. The bullet that refines purchasing machinery, that would be all important, and depending on what kind of franchise you were to purchase or acquire. So we refinance debt, we purchase existing businesses. So a franchise, buying another store, buying an existing store. Someone just found out that they didn't like working those hours, and it was more than they thought they signed up for. So we see that from time to time. Ineligible. Remember, this is a government program. So I try to keep it simple. If you think about you wouldn't want it on the front page of your town paper, then it's probably not SBA eligible. And so from that, things like Hooters, everyone knows what Hooters is. It's a franchise. It doesn't happen to be SBA eligible because the government doesn't want a picture of a Hooters girl with an SBA that we did the tax dollars to finance that. I'm not saying it's right or wrong. I'm just saying that's kind of what it is. No gambling, separation between church and state. So we can't, important aspect of the SBA program, again, doesn't matter it's like the military. Sometimes you didn't always understand. Doesn't matter if we agree or not. That's just the regs. One of the things is it has to be for profit. So under the SBA program, nonprofits are not eligible. So just an interesting. Let's see. Again, probably the big underlying thing on this, if I could drive anything home, is it's all for the business. So it's not for you to have a Ferrari or yacht. Now, if your business makes lots of money and you can do that from your cash flow, good, but the proceeds of the SBA loan can't go from the business to your checking account to buy the yacht, or that's a no-no. And remember, it's a federal program, so it has a little stiffer fines and stuff than a state program. All right, do people use this? A little bit. So the government fiscal year is the same as the military. So 9/30 is the end of the fiscal year. You can see in 2012, if you're not familiar with us bankers, how we list things, that's just shy of $20 billion. So almost 54,000 SBA loans were made nationally last year. So when people say banks aren't making loans, I kind of go, well, we're up. SBA's up. So I kind of went, I'm not sure. See, we do, we and they, someone's doing a lot of loans. That's a lot of loans. Anyone like me think that's a big number? It's kind of like surprised when I see it up there. I go, wow, really? Okay. And I can tell you, we do a lot, but we don't put a dent in that. That's a lot of SBA loans. So, anyway, so this is out there. It's available. Make you smart on another one of them. Again, if I can tap the foot like your instructors do, preferred lender is the key. That's going to make your life so much easier and pleasant. Because if you don't go down that road, then you're going to go, oh, I'm so mad at that guy that told me to do SBA. But I did tell you to use a preferred lender. All right, the 504 program. So this is going to make you extra smart at the cocktail party because some people know about the 7A program. The 504 program is a little more mysterious, and people seem to have a little more trouble. So what I learned in the military is a good example. So jump here. Instead of listing a bunch of words, I have an example for you to kind of take you through it. All right. So, and this is not a guarantee program. So the last one, we essentially have credit insurance. You get most of the time, the bank's getting this, on the 7A programs, getting a 75% guarantee on the program. Now, the reason we like that is going back to the 7A program on certain franchises, if there's tenant improvements and your collateral tends to be a lot of restaurant equipment, in the secondary market, if this had to go to a liquidation, there's not a lot of value for used restaurant equipment on the secondary market. Did I get that right, Steve? So there's not a lot of collateral. So the reason the banks like to use the SBA program is at a minimum, day one, you're starting with 75% collateral because you have the guarantee from Uncle Sam. So that's a very important aspect of the program, and that's why the banks use that. So there doesn't have to be a lot of collateral on a 7A loan. The 504 program is very different. We had the guarantee program, so the bank lends its own money, gets a 75% guarantee. The 504 program is different, and the 504 program is only for real estate and only for equipment. So said another way, in the 7A program, remember we were allowed to do working capital, we were allowed to do refinance. Those things are not eligible under the 504 program. So I like examples, and I like the simple math of it. Can we do $1 million deal? You guys okay with a $1 million deal? The numbers work easy, so I like that. So we're doing a $1 million deal. The borrower generally has to put 10% down. Again, big advantage putting 10% down versus doing it conventionally. What did I say conventionally was? How much down? 20 to 30, yeah. So big difference, right? So on a $1 million project, the difference is $100,000 to $200,000 difference. Is that a big number? It's a big number. So the borrower has to bring in 10%. The bank is going to end up doing generally, in this model, absolutely, but generally is going to be doing a first mortgage with a 50% loan to value. And it's going to be $500,000. So the property is going to be worth $1 million. The bank's going to do a first mortgage for $500,000. If you're a bank, is that a good risk? Yeah, you shouldn't. One of the big terms in banking is LGD, loss given default. If we had to go to liquidation on this, we shouldn't lose a dime if we have a current appraisal, right? Because the loan to value is so low. So the banks like this. Good thing for the banks because it reduces risk. And if the banks are happy, is that better for you? Very good. And then what happens here is no guarantee. It's actually a direct mortgage by the SBA. So they end up doing a second mortgage. Happens to be through a debenture or a bond, if you're not familiar with the term. The bank actually does a little bridge loan, and there's a bridge loan that goes on here for $400,000 for 90 to 120 days, but we won't bore you with that. When all the dust settles, you end up having two lenders that you make payments to, and the first is the bank, and the second is SBA or /CDC, Community Development Corporation, which are not-for-profits that only exist. There's 277 of them in the U.S., and they only exist to work with the SBA on the 504 program. So they actually do the write-ups for the SBA. They do the servicing. So you'd have to have two payments each month. You'd have your first mortgage and your second mortgage. You'd make them to two different places. Some of the advantages of this, again, the banks are going to like it, so it's going to be easier if you get a bank loan. The debenture, the second mortgage, always comes with a 20-year fixed product. Is that nice? It's a really nice, and right now it's about 4.65. This is fixed for 20 years. It does have a yield maintenance for 10 years, which is a prepayment aspect of it. So if you're looking, and I have had this happen, if you're looking to do a, for whatever reason you think you're going to flip this property in 3 or 4 years, use the 7A program, not the 504, because the prepayment penalty on the 504 is much higher. You can do everything pretty much 7A that you could do 504, just the 504 can go higher. We'll get to that in a minute. But so just know that it's called yield maintenance, but effectively it's a 10-year prepay on that. Traditionally, your first will be either variable or fixed, but it will be some form of fixed, meaning we generally do a 5-year fixed with a reset. So we're going to do a 20-year fully amortizing mortgage, but we're going to reset the interest rate every 5 years because we think interest rates are going to go way up, and we don't want to be sitting on a 4% interest rate for the next 20 years when our cost of funds is 8%. So that's so we usually do. So you get kind of a blended fixed, and think about that again. The debentures at 4.65. This is really inexpensive money today. All right, remember this is the debenture, so this is the second mortgage. And the second mortgage can go, as a manufacturer, can go up to $5.5 million. As a non-manufacturer, can go up to $5 million. So at a 50% LTV, roughly, how big can the first be? It's going to be in the $6 million range. So you can go up to a total facility in terms of the equity you're bringing in. This is a $12, $13 million facility. So this is big. This goes way up. And the 7A guarantee, that $5 million, is the maximum you can have ever. The 504 program you can keep using. So you can, if you were doing, I don't want to mention any franchise particular concepts and give anyone a commercial, but we have certainly $3 or $4 million projects that under the 7A program we can only do one for the borrower, and in the 504 program we could keep doing them. So it is kind of an interesting thing. So and in some cases we're even saying that we'll make the LTV much smaller than 50% on the first and make that our choice. We're looking at $13 to $15 million first mortgages on a 504. So you can be really creative with the program. That's probably, if you're just here for your first store, that's probably not applicable to you today, but it's something to have in the back pocket when you become really successful, which I hope you all will be. Let's see, maximum term on the debentures, 20 years. I talked about the interest rate. Fees are down from this right now, so fees are lower than that. They're about in the 1.5 range. And the nice part about the 504 program, the collateral is strictly the commercial real estate. In the 7A program, we do look at collateral in terms of the business, and if the business doesn't have very much collateral, then we look personally. Again, you don't have to have collateral, but the program states that we have to look at all available collateral. So this is where the term, we all have military terms. Our bank term for this is house and spouse. So if there's equity, and if you own a house and there's equity of more than 25% in it, then you're going to put up your house. It's by statute. We don't have a choice. It's not, it's not a negotiable thing if we want the SBA guarantee. Again, these have to be for profit. There is you want to know what a small business is? This is the new definition of the Obama administration. This changed about 2 years ago. We used to run into this, I would say 2 years ago, and manufacturers and retail had different size standards, and some were based on number of employees, some were based on revenue. Kind of felt like about $12 to $15 million business was kind of the max under the program. Based on this definition now, this $15 million tangible net worth, I know you're not looking at balance sheets of small businesses and medium-sized businesses as often as I am. That is a really, really big small business. 15 million tangible net worth, that takes a long time to get to. And 5 million after taxes for the preceding 2 years. I'm not advocating it, but a lot of small businesses run a lot of things through their expense structure to reduce tax liability. You don't see 5 million small businesses very often. So we almost never run into this size standard. We just did in New York a $55 million construction company. Does that sound like a small business? So that was part of what the Obama administration wanted to do, is we all look at the economy and we still want to jumpstart the economy. It's anticipated that 70% of the new jobs will come from small businesses, and obviously franchises are considered small business. 70%. So the SBA wanted to go, let's open this up, let's change the definition of small business. And effectively what they did is by changing the rules, they almost doubled the amount of eligible small businesses throughout the United States. So I think this is a very good thing. And again, it's all about job creation, as I talked about. That is a requirement under the 504, so if you happen to be talking to someone, make sure you slip in that you're trying to hire at least one additional person. Benefits, again, if it's straightforward, it's going to be 10% down. If it's a startup business, it's going to be an additional 5% down. And if it's a unique building like a bowling alley, something that can only be used for a bowling alley, it's also going to be 5% down, and those are incremental. So just FYI. But again, when I told you the commercial requirements, these are much, much lower. So does that make sense? Any questions on this? Okay, it's a great program, and remember I told you the preferred lending program, you have the PIN, we have the PIN, the good banks have that. There is no such thing in the 504 program. It all goes through the CDC. So it is important to talk to your banker and your SBA district office and finding the right CDC. It said there's 277 across the United States. Not surprising, some are better than others. So ask who's the most active, who's the biggest. You want the experienced person to work with, and they're going to really drive this program for you. But the great news is they'll walk you through it. They'll hold your hand. They'll walk you through it. And the end result is to have a 20-year fixed product at 4.65. My goodness, that's a great advantage. So it provides, again, brick and mortar, does not do working capital, so that's important. Other than the closing costs, the 504 program cannot provide any working capital. So if you're looking for a slug of working capital, you're not going to be able to get under 504. You're going to have to get it on the 7A program. And you can do 7A and 504 together. But again, have an experienced banker do it, or experienced SBA preferred lender do it, because you have to apply one before the other so you don't wipe out the other. And if someone's doing it once a year, you may end up with not enough dollars there. And we talked about the CDC, and again, your financial institution and the SBA district office. You can look at SBA.gov. Lots of information on the programs. You can find your state offices, your district offices, all under SBA.gov. All right, unlocking the credit box. So BoeFly is very active in the franchise space, and I'm not from BoeFly, so I can say BoeFly, but they're also very active in the veteran space, and they're actually, as we'll talk about in a little bit, they're actually working on a fund for veterans so they can help capitalize some of these new franchises. That doesn't exist yet. They're working on it. And so I sit on the advisory board for that, and it's something that's important. This is an interesting chart. This talks about essentially the state of franchise financing and if it's been up or down. See where it goes down here? Any guesses? I know it's an eye chart, but any kind of guesses of what year that might be? Just approximately? Yeah, '08, very good. Yeah, that's '08. And so lending stopped to a large degree. Lending kind of shut down. And so there's no real surprise there. See this spike right here? Do you know what was partly caused that? So the Jobs Act. And the Jobs Act gave two things. Gave lenders a 90% guarantee. So we get 75% guarantee, we got a 90% guarantee. So do you think the banks like a higher guarantee? It did really something important for the borrowers, and it eliminated the SBA guarantee fee. So there's roughly, on the 7A main product, there's roughly a 3% fee on that. So that's the good and bad news. If I had to tell you, I think there's a lot of great things with the SBA product. If I had to say what a bad thing is, it's the 3% fee. The good news is you can finance that. It can be financed long term in the product. Whenever I get a chance to speak in Washington and speak in front of the SBA or any of your congressional senator members, that's the one thing I always talk about is can we lower the fees for borrowers? I'm not after the 90%. 75% is fine with me. If we're going to make a good loan, I'm very comfortable with 75% guarantee. I'd like to see the fees lowered, and I've been particularly vocal on the veterans and the Patriot Express program, and I'm doing everything I can to be vocal to have the fees. Now, don't say that Rich Bratch said it got done, but Rich Bratch is being a thorn in their side, because if IFA is making a sacrifice, the banks are making a sacrifice, we want SBA to sacrifice too and take away that fee for the veterans. We think that's really important. They're looking at that. The problem is it has to go through Congress. That's something legislatively they can't just decide. Data points on funded deals. So this is BoFly processes loans to go out to different lenders, and we thought we'd just provide some data just so you kind of know what's out there. The average personal credit score was 759, which I will tell you is not our average. Yeah, that's a little higher than we normally see. Equity injection, 27%. I would also say that's pretty high. I will tell you that depending on the bank's or financial institution's appetite, we are very driven towards franchises. So, but some aren't they're going to require more down. That's a little high, I would say. And you can see the most are requiring collateral. So this chart actually surprised me a little bit in that regard. So that gives you a flavor. I will tell you, we'll get to that. I would say that generally the banks have a kind of a minimum FICO score, and that minimum is going to be 650 to 670 range, and they're going to look for a little explanation. And part of it may be I was deployed, and I was all focused. I was in the mountains in Afghanistan. I missed 2 of my mortgage payments. That's okay. We can work with that. That's if you explain and document. This is when you're doing a bank loan, it's kind of like the IRS. Explain and document, and you can get there. There's some logic in that. Best practices. This is important. This is another thing. What every bank's kind of going to generally look for is 3 years personal financials, your personal tax returns. They're going to ask you to fill out your personal financial statement. If you have an existing business, and I really, if you don't have an existing business, and I could give you a good thing to help you, but you're going to do this, and you know the name of it, establish that corporation right as soon as possible. Open up a checking account in that business's name, and the things that you start spending money on, fund it out of the business checking account. Because it's your green money, but it's going to be a lot easier for a bank to deal with your refinancing prior expensive if it's coming out of your business checking account than your personal checking account. Just a lot easier. And also, it always happens, we get down near closing and someone forgot, and bank doesn't do it, someone forgot to file for their corporate name, and they find out, oh, it's taken 3 times. And so get that done early, get a checking account early. And when you start looking at any kind of training, you fly out to the franchisor to visit them, or you stay in a hotel that night, run all that through your business checking account. It just makes it so much easier, and life is easier for everyone. There's the minimum FICO score I talked about. That's really important. And if you're in the lower end or you're a little bit under that, write the letter Y and be as detailed as you can. The banks can work with you if you took care of your mother, she didn't have medical insurance, she had a major heart issue, you had to come out of pocket. People can work with that. But people, if you just show up and the credit score is 640 and there's no explanation, it's not going to go well. What I always try to tell people is put a bow on it, wrap it up and put a bow on it, explain it. People can deal with explanation. But if you do that day one, you're so much better off than if you're proactive versus reactive, gives you a much better stance. Make sense? All right, business plan, best practices. Again, the more detail that you have. I did want to put our plug in for SBA.gov again. There are 2 organizations within SBA. One's called SCORE, and one's called SBCDs. And SCORE has a long acronym that stands for Retired Executives, and they'll help you. Their whole job in life is to help you with your business plan. You can go through SBA.gov and find the SCORE office near you, and a retired executive will help you with your business plan. And the best part is they're pretty knowledgeable, they have a passion for it, and they're free. Did I mention they're free? So you know, that's very important. Again, if you're going to go to the banker, have this thing gift wrapped first. Don't go to the banker with your idea with no math. Stop. Don't do that. Maybe a great idea, but remember the bank's not in the, you know, they're taking a risk. They want to understand the risk. So SCORE and then the Small Business Development Corporations are also part of the SBA, and they're kind of like paid SCORE people, and it's also free to you. But it's a resource, I'd say, if you're uncomfortable in the aspect of business plans, that's something you definitely look into. It's always great to get a second set of eyes. You know, it really is. It's always good to get a second set of eyes. On your personal financial statement, you do want to list whatever collateral you have, because generally that's going to be a little bit of a challenge. Again, the SBA goes a long ways to making that get better. If you have any kind of democratic analysis or any feasibility studies, the number of cars that go by the corner, whatever it is, whatever you may have that you've done or the franchisor's done for you, have that available. Your plan management structure is going to be important, because one of the questions is, what happens if you're not there anymore? Usually in SBA loans, you require key man life insurance, but we are looking to see what happens if it's a sole proprietorship and you got hit by a bus tomorrow, what happens to the business and how does that get addressed? And you should be thinking about that for your heirs and your business and your employees anyhow. So part of what we do in the SBA world is we're also trying to protect you all. It's, you know, a lot of times, and we'll get into this, where you get your money, a lot of times it's retirement benefit, you know, retirement money might be from the 401k. We want to make sure that you're doing the right thing. And you, like the bank, we're going to examine the risk. You should also understand the risk and what's out there and what should be done. And there's the very last bullet. You know, we see it all different flavors. We see corporations, we see S corporations, we see LLCs, we see sole proprietorships they're doing it on their personal tax returns. Our job isn't to, we can't give you legal advice. Our job isn't to tell you what that setup should be. So you need to talk to your attorney and CPA and friends and see what makes most sense for you. So what are some of the closing challenges? What do we, especially on the franchise side, what do we see? I thought it'd be important to say, okay, now that you've done all this, you've chosen your franchise, you've got your loan approved, you're trying to go to closing, what are some of the things, the brick walls that we run into that prevent a closing? The very first one happens all the time. On leasehold space, we're looking for a landlord waiver. And so also don't sign your lease until you know you're getting the loan. But that's to protect you again. But landlord waivers, so there's certain things the SBA requires and a commercial bank requires in turning getting access, because it's the landlord's property, not our property, right? But if we made a loan on it, we want to get access to that equipment if something bad were to happen. And so that's kind of the paperwork, and that needs to get handled. You want to have as much quotes and everything on the construction side. Again, don't sign any contracts, but have all the bids and everything in. As much as you can have, again, early, it's going to be really helpful. There's always going to be in the construction cost, whether you put it or not, we're going to lop in at least 10% for contingencies, because we know from the military, does stuff happen sometimes? Oh, yeah. And you know what? If you're doing something like hillside construction or something, we may double that, because bad things happen on hillside construction. A lot of retaining wall work, that kind of thing, can be problematic. Document any prepaid costs. Remember I talked about having your personal, create a business checking account versus a personal. That's one of the areas I'm referring to, because a lot of times it's so commingled, it's very, very difficult. Again, if you can walk away with just a couple things out of that for the cocktail party, that would be great. Franchise agreement. So this is something, again, to protect yourselves. You're going to make sure you want to get that from the franchisor. Understand all aspects of it, and talk with your attorney. The second bullet's important because in the SBA, the franchise agreement's got to be as long as the SBA loan. We can't have the SBA loan be longer than the franchise agreement, and then the reason for that is if the loan was 10 years, the franchise agreement's only 5 years, and for whatever reason it doesn't get renewed, we don't have a franchise, what did we just lend on? So that's something to The last bullet here sounds a little silly, but it's absolutely important. It happens all the time. Again, is get the names. What's the proper name? And that's really important. And in terms of dotting the I's and crossing the T's, that's very critical. In reality, so most people have gone through, if you're looking at buying a franchise, most of you have gone through buying a house or a home or a condo or something. This is not like that, all right? Other than you have to get the loan approved, it's going to be much more complicated. Houses generally fell in, you've heard of Fannie Mae and Freddie Mac. There's conventional underwriting guidelines that kind of fix in a box. So what I'm telling you is on the commercial side, there is no box. So it's a little more complicated, and it's going to take a little more time, so you have to be a little more patient. Once you get a full package, it's going to probably take, in general, getting the full package will probably take you a couple weeks. And then once you have the full package together, it's probably going to take a couple weeks more to get the deal approved. Once the deal is approved, then it has to go to closing, and that's where it becomes searching for things that you didn't get done in a residential loan, like a business. So they go through called a UCC search. They'll do a UCC search. They'll do a more intensive survey and title search on the commercial property. And there's this thing called environmental. It's a big factor that you don't run into generally in residential. The developers do, but not the homeowners. So environmental is a big play. And so what I want to do is expectations. This is not buying a house. This is going to be more complicated, more frustrating. But if you do some of the things we talked about early, it's going to make the process so much better. So some of the times I've learned, and this is where the banks can be better, but some of the times you'll be frustrated because you'll be asked to send the same document in twice. And I know that you've already sent it in, but it's the military. It's like the military. It's frustrating. If you want your loan approved, just send it back in again. I wish I could say that we as the bank should be doing a better job at that, but I will tell you stuff happens, and it goes to the wrong person, or it's we have a underwriter and a closer. Could we be doing a better job in the banking industry on that? I'll say yes. The answer is we can always be doing. We can get better every day, but rather than fight it, just send another document in and make sure they got it, because the goal is to get you closed. Sometimes it's not good enough to be right. We know you sent it in. I believe you. Let's just get it done. Financing options. So this is all directed at you're going to do part of your financing with the bank. But as you saw in any of the financing options, even with the SBA, you are going to be required to put some money in. Does that make sense? So you got to have to find the money. So in the small business, let's start at what's not on the list here. The first, most obvious one, if you don't have it in your own checking account, is family and friends. Mom and dad, rich brother, I don't know. And I'll let you figure out how you can have those conversations yourself. But that's generally where we see most of the money come in if it's not from the person's own checking account. The next after that is equity partners. So you have a business person that happens to be well off, and they maybe want to be a silent partner. You run the business, they bring in the equity, that can be part of it. Any person that's 20% or more, listen to this part too, and this if you're thinking about doing this, anyone that's 20% or more will be a guarantor. So that is a requirement under the SBA. So any 20% or more owner must be a full guarantor. So think about that when you're doing it, and thinking about carefully how much percentage you want to give them. If you're thinking smart, they may be getting 19%, for instance. 401k options and thrift plan rollovers. There are third-party companies out there. I don't know how to spell Benetrends, but I always use that as an example just so you can Google Benetrends, and you'll see a bunch of them that show up. There's about 4 or 5 nationally that do this. And they do it in a IRS-approved way. So we're able to set up, now, when you're if you're thinking of this option, get a hold of one of these third-party companies first, because they're going to help you in setting up the ownership structure so that it's IRS eligible. And you can move your 401k thrift savings plans into the business, into closing, and that can be the equity into the business. So this is something that's out there that people aren't aware of. So it's something you can Google, find out. We see it done a fair amount. we see it done a fair amount. I was trying to think in terms of franchise. I would say in business acquisitions and franchise, I'd say we probably see it done 15% of the time, maybe 20% of the time. So we do see it done a fair amount. We work with these companies, and they're good. You know, do your own homework in terms of the national ones, but they do a nice job. And never seen an SBA loan be ineligible for one, and I've never seen the IRS go after anyone in this. So I'm not an expert in that regard, but they seem to be doing fine. I've been doing this. See the gray hair? I've been doing this for a long time. So the last one's crowdfunding, and I did. That's kind of new in the world, and I would encourage you to Google it. It happens to be a space that's not currently regulated, which, as you can guess, the government's trying to figure out how to get their arms around that. So we'll have to see. That's why I encourage you to regulate it. But this is the ability to raise money a lot of times through the internet, and a lot of times it even lacks ownership. So they don't have ownership requirements. So it is something new and different to look at. It provides a lot of options. You know, I'm not as good on the technical stuff as my kids are, so you know, this is a little bit out there for me, but I know it's out there. And I said BowFly is also working on a fund for veterans, so hopefully that comes about. And if that does come about, I know that a lot of the big banks will jump in that because we think it's the right thing to do. I do want, before I open for questions, I want to say two things. One, I do want to thank you all for your service. There's a lot of passion for veterans, and I think it makes a lot of sense in the franchise space, because if you think about franchises and you think about what they're trying to do, consistency, uniformity, follow the publications and procedures, sometimes you even wear a uniform. What's that kind of sounding like? I'll think about that. So I think it makes a lot of sense for veterans. And since you, my one commercial that I don't have a slide on, but I did want to say is, because your money and what you've done for the country is important, do the due diligence on your franchise. Actually get the FDD, read it. The big things that I look at, we do a 14-point analysis on it, but I'll give you the big things. That this is the Rich Bradshaw opinion. So just kind of what I look for. Doesn't, you know, in terms of a lender. Generally, we're looking for a concept that has 150 stores or north. Have I done one that's less than that? Absolutely. In our veteran initiative, we're actually doing a lot that are less than that. But probably not going to do the 5th store in the concept, because that's such a brand new concept. That's just something from a bank perspective that we look at. We look at the litigation. On the, in the FDD, all this stuff is listed very clearly in the index. We look at the litigation. If there's 3 or 4 lawsuits, okay. If there's 14 pages of lawsuits, I'm not going to read it. I'm just done reading. I don't have to know. I don't know. I'm not a lawyer, but I know that that's not good, right? That's not good. So you know, if there's just, you know, if you just kind of look through it and go, there's a problem here. We do look at the balance sheet and income statement. I know that some of you may not have a lot of experience looking for that, but under retained earnings, you're going to want to see a positive number. You're going to want to see that going up over time, and you're going to want to see that they're making money. And the reason the retained earnings is important on some of the smaller concepts, sometimes we see that the owners of the concept are taking all the money out. We want them leaving it in some. We want them to make money. We want them leaving money in the business so that the franchisor is strong. We want to partner with strong franchisors. And then probably the most important thing I look at in there is, over the last 3 years, it has the transfers and closures by company-owned and franchise-owned over the last 3 years by state. And actually that's important. Both aspects are important to us, how they're performing, because the concept might do well in the South and not so well in the North. You know, it just depends. But we really look at, we do the math on how many stores that are out there, what the transfers and closures were, and do the math on delinquency, take the total number of stores, how many closed, and do the math. And we're looking to make sure that there's not, you know, if there's 30% closure failure, that's probably a problem. So that's just something we look at. All right, well, thank you very much. And again, thank you for your service, and have a great rest of your conference. Take care.